In Hawaii there's so much to do. There's hula, there's surfing and real estate too. We just two local guys with so much to say. So listen to the Real Estate Braddahs today.
Our 19th episode of doing this. This is the first time we're doing this live in person. We started this Real Estate Braddahs early 2018 and still going. So today we're going to run through a lot of statistics in Hawaii and get into a lot of news articles nationally. But again, here's the legal disclaimer. We are not giving you tax, legal, investment advice. You guys can make your own decision.
Pure edutainment.
Yeah.
So we did the introduction, so you guys know who I am. I think we can skip over this. You can find me on Facebook, Instagram, LinkedIn, YouTube. This month's Amazon gift card goes to Bixby. Congratulations, Bixby. I don't know if you're watching, but you'll be getting your gift card in the email later this week. Just a reminder to everybody if anyone's watching on Facebook, if you guys like, share, or make comments, then you'll be entered to this month's.
If you guys in here, you guys go to Dean's Facebook page. That's where I post this live.
So it's live now, and it's going to be still on the. So starting off, we're going to talk about Oahu real estate market. This is as of August. September data comes out in 3 days, so it's a little dated. And again, we're talking median prices, right? So in per median, you get the highest price and the lowest price, and that's the one right in the middle in terms of transactions. Takes away all of the anomalies. So if you look at the sales price for single family and median condo, we're pretty steady. I mean, it went down 3% and 2% respectively for single family and condo, but as you saw last month, I don't know if you recall, but last month we had record highs. Yeah, I think it was 835,000 for a single family. So for the most part, I think we're stable. Closed sales, we have 360 for single family. Condo was at 512. We see an up and down 2%. Yeah. And days on market for both single family and condos, we're still under the 1 month mark from point it's listed to the point that we're going into contract and into escrow. So still, it's pretty much a seller's market, but we do have buyers are getting some leverage. One of the biggest trends, if you're talking about trends, is actually there's active listings for both have been going up. That's one thing that's been consistent for the last 6 months, right? So inventory is going up. That's giving buyers a good chance, right? So that's one thing that's good for the buyers out there.
When do you think we switch from a seller's market to the buyer's market?
Well, everyone's talking that we're already shifting, right? But I think the sellers have been really spoiled for the last since the subprime rate 2000, a few years after subprime 2012. So we're seeing a shift, right? And in theory, the red arrows on the top going down, which is the median prices going down, is indicative of that. But it's still, this is the first month of that, right? Because last month was 2 going up and we were record-breaking prices. So it's but because of this and this, we're already going through a shift. And the whole industry is saying that, yeah. And I think you're going to talk about too on the mainland where they're saying construction and inventory, and you talk about rent rates too. So this is on Oahu, but on a macro level, I think we're seeing it already, or a little earlier too, yeah. Okay, so something I heard on the radio, and I know some of our followers were opinion about it, was there is actually a syndication opportunity on Oahu, and so this is called the Kapolei Tower Center, and it's open to accredited investors. The retail space, it's a phase 3. The retail area, first and second phases are 297 doors of senior and affordable housing units. These 2 are going to be the residential, and then down below is the phase 3 retail space that they're syndicating separately as a Reg D funding. They're asking for $14 million in equity my understanding is that they're not doing any leverage, and they've been trying to fund for the last month. So as of 9:30, they had 10 million of the 14 million that they're looking to raise. So it kind of sparked my interest, and I knew a couple of our listeners had asked
I'm not
about
gonna say
it.
anything.
No.
Someone might call us out on it, but normally the IR should be a little higher for development.
So the IRR is talking about is this 18% that we see. So I looked into it a little bit more, not a lot, but this is actually from the executive summary that you can get online from their website. And I actually went down to the Cully Shopping Center on the second floor. They have a little showroom here next to the Thai place, or I think the Chinese restaurant. So apparently it's two brothers, the two Mola brothers, Giovanni and Nicola. Their father, I think it's Franco Mola, is a big developer and has been for many years, developing stuff here as well as on the mainland. So I just went down to talk stories with them just to see what it was about, because I haven't heard of any syndications locally. It's the first one I've heard of. I haven't been looking very long. So again, information is because shopping center is their showroom. The IRR was 18%, and if you want executive summary, you can ping me about it. But yeah, I went to talk to them. Me personally, I'm probably not gonna invest with them. But if you want to talk story about it, it's October, Q4, right? So we're starting. We only have 89 days left in 2019. I don't know about you, but tax returns are due on October 15th. I hope you guys have got it done. But even for me, on the real estate side, for our careers, we had a Q4 planning for our realtors that Keller had for us, and it was good time to reflect and look at my goals for 2020 as well as how I want to end the year. So kind of wanted to bring that up as a reminder to everybody. And it's not about your career, it could be anything, right? Your plans, your investing. What are your goals? How do you want to end 2019? So now is a good time to look at that, as well as look at how you want to plan for 2020, because sometimes December might be kind of late, right? So getting a jump start on that helps. So it's just a reminder of that. How you want to end the year, and just start planning for the new year. And I know Lane has a lot of content, so we'll switch over to.
So we're sponsored by Good Clean Food. So if you guys don't like to cook, like I don't cook at all, we don't go to the grocery store. We just use these guys. We get pre-made meals. It's like $14, but time is money, right? So I have a podcast, SimplePassiveCashflow.com, that I started in 2016. Mostly popular on the mainland. I do a lot of mainland real estate investing. So I'm gonna like kind of spitfire a lot of these articles to you guys. If you guys have any questions or any thoughts, feel free to raise your hand. I kind of talk a lot about like personal finance stuff too. It's not all about real estate. I'm a lot more about financial freedom and financial stuff than doing a deal. But I started to do this thing. It's you can have your cell phone track you on your phone. I guess the scoops is they're just trying this out at this time. It's not really collecting data. They're just trying to pilot it in at this time.
So they say.
Yeah, well, as they're trying to rate you, right, as a driver too, right? But supposedly it's not fully rolled out yet. But I don't know. It's kind of like Big Brother is watching you, to me.
Like speed and all that.
Yeah, you can't brake too fast. You can't drive too fast. You get flagged when you go over 80 miles an hour. Yeah, so next thing here, file your financial planner. I don't have a financial planner. I don't believe them. I mean, just look at these numbers right here, all the real costs that they're costing you.
We always talk about that, yeah.
Yeah, I mean,
it's a true number.
When I was starting out in real estate investing, I was buying turnkey rentals on the mainland, making 20 to 35% a year. Why is it that when I was in my 401k, just making like 8-10%? Like, who took all my money, right? That's why all these Wall Street's the way it is. And that's why people are stuck at their day jobs. They're like 60 years old.
And that's also why guess we're not having the financial advisors on.
Yeah, so we don't have any financial planners here.
We won't be able to
do it yourself.
We won't be able to after that last slide. Right?
I joined like a financial planner group because I just wanted to see what their marketing was, because that's just the weird stuff I do these days because I don't have anything better to do. But here's some of like the things I cut and paste here. So they're like, oh, you know, like you got to sell people like their subscriptions like Netflix, right? Because people are broke. They can afford $14, $15 here or there, but they can't afford a $5,000 retainer. So sell them on the subscription. Next thing, you know, they're trying to get people, millennials, you know, but you know, there's this term AUM, assets under management, which is a big thing. And I think a lot of people are like, well, I don't have $4 million, you know, financial planner doesn't want to talk to you. And yeah, you're right. Nobody wants to talk to you because you don't have that much money. A lot of these guys are changing their schemes up to having minimum of fee, just setting the minimum fee, which I think is ridiculous. They get paid even if you lose money. And they, I'll just skip the next slide. That's enough on that, right? So Michael Burry, the guy on The Big Short, the kind of eccentric character, was it Nathan Bale or Christian Bale, right? Yeah. So his character in that movie, he had this article on Bloomberg where he's saying, you know, everything's going to come crumbling down, where the equity markets are, right? Because in my opinion, equity markets, stock, bond, mutual funds are all sort of fake money infused in with money from the government, how they manipulate rates and stuff like that. So he's saying, my takeaway here is the equities are sort of intangible assets. It's not like real estate where you can rent it out for income. And I'm going to show you a lot of articles today that are like one way and the other, not really left or right like that, but like, you know, they sort of contradict each other. And this is what news articles are supposed to do, right? They're supposed to, you know, spin people up, right? Get people pissed off and then have them read the next day, right? So just remember this Michael Burry guy, he's the same guy investing in water, was how that movie ended. A little crazy to me. So here's a throwback article from 1999. The highlight there is, you know, Fannie Mae and Freddie Mac used to be private agencies, but they got taken over by the government in the big bailout. And here's an article saying extending home mortgages to individuals whose credit isn't good is not a good idea. Go figure. And today, I mean, a lot of the people you're working with, they got pretty good credit, right? And I think that's one saving grace. And you look at like the housing prices have kind of rebounded, is you don't have all these ninja loans. It's pretty hard to get credit. Like I help a lot of people get rental properties, turnkey rentals out in the Midwest. Sometimes I'm like, wow, you can't qualify. Usually it's because their debt to income ratio is not the greatest. I think you need like a 50% these days, but yeah, so if you got, but like you still need a credit score of a 620 these days. So good quality people are still getting homes. It's super cool. But it is changing. Like, I mean, kind of going back to like, I think like 5 years ago, you could go get a loan or you needed cash reserves for a lot of these rental properties you purchase. So back in the, I say back in the day, but like 5-10 years ago, cash reserves, you could count like 50% to 80% of your 401k as cash reserves. Then a few years ago, that went up to 100%. So you can slowly see how this is sort of a slippery slope. Things are always changing. Well,
and then after subprime, that crash happened and everything ticked up so right. much, right? And it started losing up. I think one of the news articles we had maybe 6 months ago was talking about, you know, subprime is gone, right? No one wants subprime. So now they're loosening the underwriting for the packaging, and then now they have non-prime.
Yeah.
Remember that story?
Yeah, they're being a little more correct.
Right. So it's cyclical in terms of when they're giving money out.
Yeah.
So I think to your point, it's like it gets really tight, and then you start losing it, right?
Yeah.
So even like Fannie Freddie loans, right? It was 4, and then now it's 10 now, right? And it keeps on changing.
Yeah.
So always constantly talk to your loan officer if you're doing Fannie Freddie loans, because the maximum is always changing and the underwriting is constantly changing too.
Yeah, another slippery slope thing I see is like appraisers. Like after the meltdown, the appraisers were the ones that got hit the hardest because they're like, you dummies, like you appraised this thing for too high. So the rules and regulations got really strict. And I don't know how it is in Hawaii, but they have like AMCs, like appraisal management companies that sort of divvy out the work. It's getting a little loosey-goosey in my opinion. I mean, sometimes I see the same appraisers, and I don't know how that happens. It's supposed to be random. But anyway, moving on to everybody's favorite topic, Mr. Trump. So his article here is saying he's signing an executive order to tackle the lack of affordable housing. One quote here is, only 7 homes were built for every 10 households formed in 2010, 2016. So as much as prices are going up, there's a big demand for housing. And that, it's supply demand, right? There's still enough demand. Probably more.
Good thing for landlords.
Good thing for landlords. I think it's the luxury and class A folks that are going to hit the hardest, and that's where the oversupply is coming on. Everything new that's being built, and I think I have some slides later on new inventory coming in, because as an investor, you want to see where's new inventory coming in. Well, all new inventory is always going to be class A. You don't build class B and C inventory.
The margins are for the developers. Right. That's where the margins are at.
Makes no sense to build, even though it's sort of idealistic and everybody wants to make housing for the masses. It doesn't make any sense. No one will do it, right?
Just think that Victoria, it just got approved. There's no hope, but you gotta hurry up and build your affordable housing before you start that. Everyone's getting the class A stuff up while they can.
A few more article here. Treasury unveils plans to privatize Fannie Mae and Freddie Mac. So they're thinking about taking Fannie Mae and Freddie Mac back to being private. And I think these are like, I put that's always my commentary in those brackets. It's like, I always like, people are like, Lane, did you hear about like Fannie Mae and Freddie Mac's gonna go, we're not gonna have Fannie Mae and Freddie Mac loans. I'm like, slowly roll, relax. First of all, it's the government. It's gonna take forever and a day for this to happen. And I think unsophisticated investors get really excited with this stuff. And this is like, number one, no offense, Dean, but brokers love to do this to people. Like, oh, you better buy this house. You better buy this $1 million house before it goes away. You don't do that, okay? Well, because maybe all you guys are buying cash. Yeah, I mean, people always need places to live, and people always need loans. For people in private placements and syndication, this is one that I digged up. Jobs Act 3.0 is what it's kind of code name is being in the works. The next couple ideas they have are like, well, we're gonna call, instead of like, an accredited investor is $1 million net worth or above, or you make over $250,000 a year. So what they're saying is, well, maybe we're going to change the definition so that maybe if you have an MBA, or you're an engineer, or you're some other like occupation that supposedly has some like accredited investors like clout, you can be an accredited investor, and this would open up a lot of more of the Jobs Act. The whole point of the Jobs Act is like to open up and stimulate more economy, get more investment out of Wall Street into Main Street. But then sometimes I hear articles like saying that the accredited investor definition is going to go up to 5 million. I'm like, oh man, now we're not going to get anything done.
Tighten it. Yeah. Tighten up the money. I mean, but what sophisticated, right? Isn't that what you're?
Yeah. So the 506B deals, you're always going to get in prepared, right? But it's the 506C deals that, in my opinion, I don't know if they're quite the best, but they get mass. That's the reason why they get mass marketed out there.
Well, they did loosen it, right?
Yeah.
Crowdfunding got loosened up so much.
Jobs Act 2.0.
Yeah.
So, but I think people say Jobs Act 2.0 was a big thing. In my opinion, it didn't change that much.
For your types of deals.
For the world. I mean, if you go on Edgar, on the SEC website, 97 to 90% is what I heard of deals that are still 506B. They're still within personal networks. They're still country club deals. So only the 506C deals are the new Jobs Act 2.0. It's a huge minority of all the deal flow out there. So in terms of stocks and mortgages, kind of went up and down the last month. Here are the big three things that have affected loan rates. The China trade dispute, and we've been talking about this for the last 3 months, right? It's kind of quiet right now. Not much just happened. The global economies are kind of slowing down. So, this is sort of the reason why they're cutting rates, what they say. I have my theory. My personal theory is that Trump is sort of pressuring the Fed to cut rates, so it stimulates the economy, and that's what pumps more artificial money into the stock market and keeps everybody happy, keeps keeping them elected.
For the election year, re-election.
Yeah. Any other theories out there? The bipartisan group here. August 5th, mortgage bonds hit a 2019 price high. And I think they're probably going to cut rates more, but I think cutting the rates probably won't lead to our interest rates for home loans and et cetera isn't going to matter. There's a disconnect.
It's not directly related. Depends on if the market has baked that assumption already into the fact that they're gonna.
Yeah. So here's that article that I pulled up, and you remember, like, all these articles are just like, if anybody was an English major in college, I have some friends, you can write anything as long as you back it up, even though it's not true. So just have that lens when you look at these. So commercial property executive says that there's a little bit of dip in some of the new construction. It could be a slowdown, it could not be, I don't know. I know when I look at like the big news sources like CNN, Fox, Bloomberg, I don't know. I mean, I don't really trust it. If you guys are looking for a great resource, I subscribe to ITR. It's a paid newsletter, but they're saying that right now we are in a slowdown, and I can show you the signs. I think I'm going to talk about Miami, and we all know San Francisco has been really soft for the past year too. But they're saying right now we're in a slowdown. Should be slow the first part of 2020, but then we should start to pick back up. And there's your recession, folks. That was your recession.
That'd be great.
So this is, I know I put this in here for Hawaii people because Hawaii people like to gamble. The reel is switching hands. And one guy asked, so what about the World Series of Poker? Yeah. Who is this guy? But this is just an example. Like the reel is an older asset, right? I like Class C, B apartments. People are like, well, why don't you hold on to those apartments forever and cash flow forever? Well, I mean, this is sort of what the pros are doing, right? They sort of let go of assets after they give them up the best part of the life. Oh, that's a lot. So your boys at PricewaterhouseCoopers, what is that the name?
PricewaterhouseCoopers.
Yeah, it's a big accounting firm. They put together this big insights report every year. I wake up like Christmas morning whenever I see it come through my inbox every year for the past 5 years. But here are some of the takeaways. You guys, we'll send out the PDFs for you guys to take a look at this later. The videos, you guys know how to all the videos on RIL.com. You guys can read through this later. Some of it doesn't really make sense. Like that last one, that's fluff, or accounting fluff. But the takeaways that I took from it was, here's the population where it was 1950 and then where it's going to be. I mean, the population is going up in the world. And here are some of the populations in different countries. So the purple line is urban. The rural line is the orange line. So some, like North America, the movement is more towards urban right now. And that is what, 1950, right? In 1950, and they're projecting it to go much more urban. Right? Makes sense. Everybody's coming into the cities, moving from the country into the cities. And not cities, particularly like New York or Los Angeles, but places like Kansas City or those type of cities is what they're talking about. This is maybe it's close to home to some of you. Forever 21 is bankrupt. And I think the first reaction for most unsophisticated investors would be like, see, Amazon is just killing these guys, right? E-commerce is going to take over. But in actuality, I went and hunted for this one article because everybody was talking about this, but only these guys, shopping center business, is saying, well, when you really look into it, it's not that e-commerce is destroying all these businesses. It's really just their debt, amount of debt this company is holding.
What's the difference between Chapter 11 and Chapter 7? Chapter 11 is a reorg, a way to get out of restructure your debt.
Okay, Mr. Accountant.
Chapter 7 is the one where you're gonna go away.
Okay, I didn't know that. Yeah, I mean, e-commerce, Amazon. When you look at the stats and like, yeah, they always keep having record Black Fridays. It's always the news headline. But when you look into it, they're a very small minority of all sales. And yeah, it's going to continue to grow, but it's still a minority. And this is why Whole Foods or Amazon bought Whole Foods, because they know at the end of the day, a brick and mortar is where it's at. You're not going to replace that. Maybe one day DNI will get a brick and mortar office and have to go somewhere and put on real clothes instead of just working from home. But so here's this article that I found from Wolf Street, a very fringy news source than what I personally like to read a lot. Tyler Durgan is his name who writes this. I don't know if it's the same guy from Fight Club, but he sure uses the same profile icon. So Miami, you can look at some of these neighborhoods in Miami. It's just a bloodbath out there. And this is a luxury class A. It's Florida. People will say, "Oh, I'm going to go invest in Las Vegas, Florida." I'm like, why would you do that? Those guys got killed the last recession. This is exactly where all the unsophisticated investors go. Some articles on house flipping, their profits are going down because maybe it's the rise of HGTV, people coming in and doing these high-risk flips. I just joined up Collective Genius, a mastermind of probably the top 2 house flippers from every single state. No one's from Hawaii. That's why I joined, because I'm the only guy from Hawaii in that group. But they all kind of joke and laugh because they say, well, let the HGTV people do those kinds of flips, right? The wannabes. And then, if you got a crappy property you want to unload, bring it to the Locaria, right? Because the Locaria is where a bunch of newbies that want to go and buy real estate. Hopefully this is not this, because we are more of a passive group here, and I'm not a big fan of flipping. You can invest in house flipping 2 ways. You can be the operator, the person taking on all the risk. I just think that's a job. Or you could be the passive investor. But I mean, if you're making 8 to 12%, you got to put in huge sums of money, $200,000, $500,000 or more. And the main thing is the active income. And as an ex-professional, taxes, it's more of a tax game than returns.
It's a segue to...
Yeah. Here's my tax return. I pay 4% to the government. Yeah.
Even the president did it.
Yeah, even the president did. No, he actually probably did a lot better. He probably didn't pay anything.
Okay.
Yeah. But...
So basically you're looking at that number right there.
Yeah, so AGI was 136, and I only paid $7,500 in taxes, 4%. And why? Because I passively invest in real estate, and those passive losses I used to offset my income.
So what was this?
I sold a bunch of properties, so those come up as capital gains. And then I had $200,000 of capital gains, so I brought over the passive losses on line 17 to knock it right out. So net 0.
It's pretty neat.
And I know a lot of people talk about 1031 exchanges. I don't like 1031 exchanges. You guys are going to do a 1031 exchange. I will tell you the cons against them because they're not the right tool for everything. But we're getting to the end here. I've been reading this book by Cal Newport about deep work. So the basic premise is a lot of us are doing shallow work these days. And I think I do it all the time. Like you're on your phone typing a stupid comment on Facebook or Instagram, or doing like a quick email that takes 5 minutes. Like yeah, you got to do that stuff, but you don't get compensated, or you don't create value, more importantly, unless you're doing things that take a lot of time and deep effort. And I think if you can consciously look at like, what are you doing? If you're doing something that's easy, well, you know what? You should just have a machine do it, or just have somebody who has a lower hourly rate do.
It's like the one thing.
Right. So I had a investor get together recently, and we like to get this group together a lot. We haven't had one in a while. Been traveling, but I think maybe the next one we'll do pie or something like that. Maybe we'll go back to Beer Lab. But any questions? Oh, perfect on time. But yeah, any questions from the group? This is kind of open forum time.
What's your investment outlook in Hawaii? I know you showed that one thing up there.
So, talk about, well, Hawaii has always been, not always, but it's more of an appreciation thing, right? You're not going to be getting a cash flow like how you get in the mainland. This is for residential. So my outlook on it is that, you know, we're already on an island that has a housing issue, housing crisis, right? Especially affordable housing. So, and we have a lot of administration and red tape when we're trying to build new stuff, so to get stuff. I mean, Kawaoka is going up, you're getting stuff. On the west side, you're getting stuff in Eva, and then Core Ridge is coming up in 2020, you know, right by the Costco in YPO. So there's like 3,000 doors that are going to open up there next year, Castle and Cook. However, I still think we have so many multi-generational homes. We have people living with their parents or their grandparents because they can't afford housing to buy their own place. So I think, you know, when the correction happens, if it's in the equity markets, or it's also gonna come to the real estate side. It's gonna affect everything. But it's kind of similar to like a subprime, where places like Vegas, Florida, Atlanta, they got hit, right? 50, 60, 70% reduced. We look back at historically in Hawaii, I think it went down in the low teens, like 11 to 13%. It decreased, and then it came back relatively quickly. So, I mean, if there is a big macro correction, I don't think it's gonna affect us too much. And well, so I'm an investor I try to invest for cash flow here and on the mainland. So I have stuff that's cash flowing, and for higher cash flow, you have to move further west, right? Because the rent to value ratios are higher there. So I'm out that way. If there is a correction, I am not, knock on wood, I believe that I'll be able to ride it out, because even with the kind of cash flows I'm getting, I think even if I have to reduce rent, I'll still be okay. Investing in Oahu is a whole new, we're truly different than the other states, and you know, when people say that, there's a lot of truth to that. I mean,
do you think that there's actually, there's got to be some money to be made, but really worth the capital investment to like do things like invest in like affordable housing type things? So let's say like the state, you know, they'll give somebody a land lease for like 60 years or something like that. Like, oh yeah, build something for us, but you don't own it.
The answer is like the economics just aren't there, and unfortunately, I don't think the government has subsidized it the right way. I mean, look at that syndication deal we're talking about. The way I look at it, and I pointed out, it's like, oh, Dean, how come they don't have debt on the property? You know, you mentioned, and I said, oh yeah, because they can't get debt. Nobody will finance them. You know, of course, I gotta be careful what I say in case somebody comes back and says, but yeah, because.
And you know what? In their defense, asking that question while I was there.
Yeah, what did they say?
He said, they said they could get the debt. I don't think they tried, but they said in their minds they could have got the debt if they wanted to, but they chose to do it 100% equity. And I think it's the executive summary. It's kind of a fast in and out play where you're gonna get that thing up, you're gonna get it rented out, and then they're gonna. I think 2021 was the point. So it's a really quick turnaround. So I'm not sure if that's the reason, but you know, I tried to talk to them, and I don't know if I went on I went in there with my baseball cap and my slippers and my board shorts and saying, this guy's not accredited. So for whatever reason, they didn't. I went in the afternoon too. Maybe it was late, so they weren't really sharing so much with me. But
When you say equity, you saying they're going in there funding it themselves?
yeah, so that 14 mil that they're trying to get, that's the whole play. They're not getting any debt to leverage off of.
Usually they call this like if you want to sound cool, you say, what's the cap stack? Right. So the cap stack in most deals, it's like, well, you have investors, private equity coming with 20-25% for the down payment and your rehab budget. But then you also have the bank to come in for the senior loan, which is 70-80%. Or it's like a stack, right? Mm-hmm. So in that project we were kind of talking about, they're bringing in all private equities financing the whole thing, mm-hmm. which brings down your returns, right?
Because you're not getting that leverage, right? On your dollar. Yeah. Because each equity dollar is backed by X amount of loan. So mm-hmm. that's like acts as a multiplier.
Yeah, this one has no leverage.
But I mean, yeah, up to you to make that decision. You know, I didn't really dig into it, and but there one more week. I think they said they're going to be looking for funding.
Yeah, but we'll see. I can just do a radio ad apparently, huh?
Yeah, I heard even the listener too. Yeah. I heard on the radio. That's what started the conversation on Facebook, and that's what made me go look more into it. Yeah, you never hear about syndications opportunities on. Well, I haven't, but I haven't been looking very long. I've done one deal so far, and that's actually with Lane, El Paso.
Yeah, I mean, 90-97% of deals out there you and I don't see because we're not in those private networks. So it's all who you know.
So which makes it interesting that it was a radio.
Yeah.
A good question for that.
Any other questions? Yeah, go ahead.
Yeah, so can you talk a little bit about the tax deduction for syndication, like the benefits of it, versus me investing in just like a single family housing?
Yeah, so when you have a rental property,
professional tax advice.
Yeah, we're not professional tax advice. So he still has his
I'm inactive as my CPA. I'm in good standing.
Inactive CPA, right? So normally when you have a rental property, you can deduct the property value, not the land value, right? That the land doesn't degrade, but the property value, the building improvement, you can depreciate over 27 years. So what you do is you take, say, I know these numbers off the top of my head. So when I had my first property in Seattle, I bought it for about $400,000. The land value is pretty high in Seattle, similar to Hawaii. I believe the land value was like maybe 200, 250. So 150,000 was just the building improvement, which you depreciate. So you divide that by 27. I think it came out to be somewhere around $6,000 to $8,000 a year for 27 years. And that's when you're doing it, on your own. But what's the secret juice is with these bigger deals, you can do a cost segregation. So you get an engineer in there. What he'll do is itemize all the components of the building. So the drywall, I don't even know what they do. I don't know. They just make this huge report. They give it to the CPA, and now the CPA can take certain components and deduct it all in year one, more aggressively or shorter time
So
schedule.
theoretically, you can do that when you're buying your single family too. It is doable, but it may not be cost effective to hire the cost segregation.
So
to
cost
get the report.
segregation typically costs $10,000 to $20,000.
So for that, in year one, you get that huge deduction. What about year two?
Well, you've got most of the juice out.
Yeah, that's fine. Because they take it up. It's like a one-time bonus. They call it a bonus.
Yeah, but for real estate professionals who can designate that on your taxes, you can take that and offset your.
You may be able to.
Right, you may be able to if you can demonstrate that you're an active participant. I'd be careful here, the way I say it, but I don't know, man. I did it. I'm still here.
You didn't file your No, I just
I just follow the legal advice of my tax attorney.
Turbo tax.
I stopped paying turbo tax a long time ago.
Turbo tax.
Yeah, you don't want to have, in my opinion, you don't. I was actually doing TurboTax when I was doing the 27-year straight line depreciation for a while. And now I look back and like, what the hell was I doing? That was so stupid.
And then of course the back end, because I have a 1031 that's at 27 years. The depreciation recapture tax is just so high now. I'm at like $100,000. So even if I sell it, once I sell it, I don't get it back. It's all gonna go back to depreciation tax.
Because he's getting the benefit of it now, right?
Right, he's
Yeah.
getting the benefit now,
Yeah.
and then
I'm kicking the can down.
So basically, that's reducing your basis,
Yeah.
your cost basis, right? So when you calculate the gain, your basis now has gotten smaller, and what your resale price is, it makes your gain get bigger, right? In theory.
Yeah.
So on the back end, so that's why proper planning, depends on how if you're gonna ladder it, get into the next deal so that bolt rate you can just, so that next deal will have another
Yeah.
credit or bonus depreciation hit, so you can apply that. Actually that's exactly what you did with that 198 versus.
Yeah, I
220.
sold that year. I sold 7 properties, and I think I
Yeah.
harvested $200,000 of
So that
depreciation
gain-
recapture.
that
From the syndication.
No.
Oh.
Just from regular real estate, showing rentals. Exact same situation. That was all 1031 from a previous 1031. So I was going to get creamed, $200,000. But all these other deals, they accumulate passive losses in a bucket, and I can use it to extinguish it when I need it.
So that's what I need to do, just accumulate.
And you
and then
accumulate a
sell
bucket.
1031.
Yeah, so don't sell that thing yet until you have enough in the bucket. There are things called like installment sales, but those are very expensive, and I think the lawyers like to push it because they like to make money off of that stuff. Just like the same thing like 1031s. 1031s are sort of expensive, but the biggest thing why I don't like it is because you're always a distressed buyer, right? Everybody knows like, oh, we got a sucker over here, right? We got a 1031 guy, like let's get him, right? They're trapped. You're trapped. Right? You're gonna pay 105, 110%. Right? I'm sure all the realtors, right? We hear it all the time, right? Oh, we got a 1031 guy, right? Oh, I guarantee this guy's gonna overpay. Depends, right? If he discloses that, fair game.
So when they're selling these,
Yeah.
but on the selling side, that's typically that's the
Right.
first transaction to
Right.
trigger the buy, right? Because then you have that time. frame.
Yeah. I mean, most times residential world, people aren't doing 1031 exchanges, but in the commercial world, you bet everybody knows you're doing 1031. There's no hiding that stuff. A seller, if you're selling the property, and if you're buying the property, your broker should be pitching you as a potential buyer. And they need to be showing that you're a stronger buyer. So they will spill the beans and tell them you're using 1031 money. And at that point, all the investors cheer and yell and are so happy they have a 1031.
Are we live right now? I had a deep question.
We are.
We are live.
It makes me nervous.
Free real estate investing group, check out reialoha.com.
We're just two local guys with so much to say. So listen to the real estate Braddahs today.